So we'll start with the relevant cash flows and costs. Not all cash flows and costs are to be considered while evaluating a decision. Certain cash flows and costs are to be ignored and they are not useful in making a decision. Okay, so in a 2 mark sum they will ask you whether a particular cash flow or a cost is relevant or not. So you have to just make a selection whether a particular cash flow is relevant or not. Okay, or in some questions they might ask you, if a cash flow is not relevant, why is it not relevant? Again, it's a 2 mark question. Sometimes the same topic can also occur in a 10 mark topic where this small area would be like asked for a 2 mark, where you will be like given a several costs and you have to identify which of them are relevant and which of them are not relevant. Okay, so in terms of application, the same chapter keeps on coming for all the problems. So irrespective of whether it's ARR or IRR or NPV, this relevant cash flow and cost is something which is common to all the investment appraisal methods. So we'll see like what costs have to be ignored. We have to ignore sunk cost, committed cost, non-cash items, and allocated fixed head office cost. So we'll start from sunk cost. See, sunk cost is a past cost. Okay, you have spent this cost in the past, so this cost is not useful for future decision making. Okay, you don't need to consider this for future decision making. So that is about the sunk cost. So what we'll do, we'll start with the example. So assume that you have spent some 5,000 rupees as market research to find out whether a product can be sold or not. So this cost you have spent in the last month. So now you have come to a decision making where you have to decide whether you have to invest in that product further and produce it, or you have to just drop it. So the cost of investment is 0. We'll assume that to be 0. So if you invest, you'll get 4,000. If you do not invest, you won't get anything. Okay. Now it works like this. If you take the market research cost into account, you will end up with minus 1,000. So 4,000 is the income, 5,000 is the market research cost, and you will feel that it's not worthwhile to invest at all. Okay, because you're earning minus 1,000. If you do not take the market research cost into account, you will end up with 4,000. Okay, so what we'll do, we'll see the payoff option for the other option for do not invest. Assume that you are not going to invest, your income is going to be 0. Already you have spent 5,000. The minus 5,000 is the loss if you take the market research cost into account. If you don't take the market research cost into account, you ignore it. As you ignore it, you are ending up with the 0. Now, which one is the right option? Should you consider the market research cost, or you should ignore the market research cost? Which is the answer? Market research is a past cost, so do not consider. So what happens is you have to take these alone. So what happens is either you ignore the market research cost here and you also ignore it here. So whether you want to proceed with the investment or not, you have to proceed with the investment. Okay, so proceed with it and earn the 4,000. So hope you have understood this. We will move on to the next topic. So we'll move on to something called as a committed cost. Okay. So submitted cost is very similar to the sunk cost, except that you have not paid for the expenses. So here what happens is you have promised or obliged to pay a certain amount in future. So you have made a promise to someone that you will pay a particular amount of money. So as you have committed, whether you take a future decision or not, this cost is not required to be considered. We'll have an example. So the example works like this. You have entered into a rental agreement with the landlord and you have promised to pay 5,000 rupees per quarter. So this agreement is for a 12 months period. So you either break it or not, you have to pay the rent. So quarter 1 you pay 5,000, 2 you have to pay 5,000, 3 you have to pay 5,000, and 4 you also again have to pay 5,000. Suddenly in quarter 4 beginning you are closing the business. So should you think about this 5,000? Okay, the answer is you should not worry about this 5,000 because this 5,000 has already been promised. Okay, promised to pay. So whether you start a new business or whether you want to close down this business, you don't need to worry about this 4,000 because it is a committed cost. This 4,000 is a committed cost, as whatever decision you take, you have to incur the cost. So that's about committed. It is very similar to the sunk cost, except that in sunk cost you have already paid, in committed cost you have promised. So we'll move on to the next. There is something called as a non-cash cost. So non-cash items refers to depreciation, amortization, goodwill written off. Non-cash items should not be considered in a decision making. If tax is given, then you can consider the non-cash item. So we look at an example. So the example works like this. This company has a depreciation of 50. Okay, but what they do is they don't want to consider it. They're not considering it because just now we have said that if there's any non-cash item, don't consider it. See, that no, do not consider is correct when there is no tax is like in the problem. If tax is given in the problem, you have to consider the depreciation. In this problem, there is tax given. So you should consider the depreciation. If you do not consider, see what happens. The income is 100, PBT is 100, tax is 20, PAT is 80. So your cash flow should be 80. It's not 90, it's 80. So this is wrong. We'll consider the depreciation. So the income is same 100, depreciation we considered here as 50, profit before tax falls to 50, tax is at 20% comes to 10, your PAT comes to 40, you add back the depreciation. So when you add back, it comes to 40 plus 50 comes to 90. See, look at the difference here. Earlier it was 80, but now your cash flow is 90. How come? See, the tax has effectively fell down. Here the tax we paid is 20, but here the tax that we paid is only 10. How is it like possible? See, it's possible because that we considered the depreciation and we again removed it. See, we deducted the depreciation of 50 here, but we've also added back the same 50 here. So it is getting nullified. It is getting nullified. Okay. So the concept works like this. In a problem, if they have not given you tax rate at all, okay, just ignore depreciation, amortization and goodwill for these calculations. If they have given tax, then consider these amounts like this, deduct them, then calculate tax and then add back the non-cash items like this. Okay, so this is a very crucial point from the exam point of view. Hope you have understood. We'll move on to the next topic. So we'll start with the allocated head office cost. So we'll look at an example directly. So this is a company Zco. They have two divisions, A, B, and with a total of them. So income is 100, 100, 200. Head office cost is 50, 50. The total of it is 100. The profit comes to, after deducting this head office cost, it comes to 50, 50. So the total of both comes to again 100. Okay, so the 100 is the profit. Now the company is trying to invest in a new division. The new division comes like this. It also earns another 100. All other numbers remain the same. Now the question is, the head office cost is a allocated cost. Okay, allocated means the company is only spending 100, 50 plus 50, 100. Okay, so it is not, this 50 and 50 are not the cost of A or B. It is a common cost. Just because there are two divisions, they have split into 50 and 50. So should you again give another 50 for division C? Okay, the total allocated head office cost is only 100. So should you give a 50 here? The answer is no. You should not give 50 because the entire total itself is only 100. How can you give another extra 50? So you can ignore. This is wrong. So this is wrong. So what you do is we will work it out in a different manner. We'll work it out like this. The total incurred is only 100. So allocated to A and B alone. So should you invest in C, and how much income does C make? C will easily make an income of 100. Okay. So should we worry about the 50 and 50? No. This is the allocated cost. It's already recorded by A and B. So C will not have anything. So you can just take the 100. Okay. So what happens is the total profit of the company goes to 200. See, if you consider the another additional unwanted 50, your profit, see how it falls, it goes to minus 150 because you are unnecessarily you have added this 50 here. So which one is the right approach? The answer is ignore the allocated fixed cost while making decisions to invest or not. So you just have to ignore these cost. So that's about allocated head office cost. So we'll move on to the next one. So apart from that, what cash flows should we consider? We should consider any cash based cost, any incremental cost, any additional infrastructure cost, any tax, marketing, the resale value of a machine or a factory, any working capital required, future cost that are we going to incur, and also the opportunity cost. Okay. So out of these, opportunity cost is a very important topic. So we'll discuss about that. So we'll discuss about what is the future cost. Future cost is a cost that we spent in the future. Okay, it's not spent in the past. Past cost becomes sunk cost. Future cost is you're going to spend it in the future because of taking a decision. Okay, because of taking a decision. So here is the decision. The decision making is here. If you want to produce a product, you have to do market research, and market research is going to cost you 5,000. After doing market research, you will come to know whether to invest or not. If you invest, you'll get 4. If you don't invest, you'll get 0. So if you take the market research cost, you will end up with minus 1,000. If you again take market research cost and if you don't invest, your profit will be 0. Which is a better option? The better option is do not go with this product, because in the future only you have to spend this 5,000. Okay, even if you invest again, you produce, you will only get 4,000. So it's a loss of minus 1,000. So you can better drop this project. So we'll start with the incremental cost. Assume that you are already spending 5,000 rupees for a particular machine, and if you want to expand the capacity of the machine, you are going to spend a total cost of 9,000. So already 5,000 you are spending. If you expand the capacity, the total cost then comes to 9,000. So you should consider the difference between the two. Okay, the existing cost and the new cost. So something like old cost and the new cost. The difference is called as incremental cost. Okay, so incremental cost is the new minus old. Okay, so that gives you the incremental cost. So now we'll move on to the opportunity cost. A dentist is planning to use a room in his house as a clinic. He expects to make an income of 10,000 rupees per month. Okay, we have two scenarios here. The first scenario, no one in that area is coming and asking for the room for rent. Okay, in that case, what would happen is expected clinic income is 10,000. No one is like asking the same room for a rent, so there's nothing he is like losing from his hand. So the opportunity cost is 0. The only opportunity that he has today is running the clinic. There's no other opportunity, so the next best opportunity is 0. The net income is 10,000. We will have a second scenario. In the second scenario, if Mr. X has asked the dentist if he could use the room and pay 15,000 as rent. See, now the same room can be used either as a dental clinic or it can be rented out to Mr. X. So this is a opportunity cost. Even though it is not a cost, it is a foregone income. So any income that you forego is a cost. So if he runs the clinic, he will earn 10,000. But the thing is, he has foregone 15,000. Now his total loss is actually 5,000. So that is a problem here. So that is also opportunity cost. Many people don't consider the opportunity cost. Opportunity cost is you are foregoing some other opportunity, and that opportunity is a cost for you. So we'll move on to the next topic. So there are like benefits that have to be considered. Any additional or incremental sales or a profit, savings in salary, savings in operating expense. These are cash flows that we have to consider. You might think, why is savings in salary and savings in operating expenses a income? See, you are reducing a cost. So that is similar to earning income. Okay, so a penny saved is a penny earned. So we can put it like that. So we'll have a quiz. What is the opportunity cost of the land used for development? So what is the income that we have foregone? We can take it like that. Seco has paid 1 million for a land 3 years ago. Seco estimates that it could sell the land today for 1.2 million. If the land is not sold, Seco plans to develop the land at an initial cost of 1.5 million. Seco estimates the net operating cash flow during the first year following the development would be 0.5 million. Okay, so what is the opportunity cost? See, you have the company has two options here. It can either sell the land, that's option number 1, or the second option is to develop it. He's asking you, what is the opportunity cost of the land used for development? So development is the option they are choosing. So what is foregone here? What is foregone? If this option is chosen, this is foregone. So this becomes the opportunity cost. So opportunity cost is 1.2 million, which is answer B. So that is answer B. Okay, it's very simple to understand. First, to find out, there will be always two options in opportunity cost. One of the option is what the company intends to do, so the other will automatically become the opportunity cost. So the second is the option chosen, means the other becomes the opportunity cost. If this is the option chosen, then the other becomes the opportunity cost. Okay, so there's always one option chosen and the other one is a opportunity cost. Okay, so that's about this question.